Welcome to Real World Real Estate, where we will explore, examine, and explain the real process of buying or selling real estate. Here is your host, Stephen Clyde.
Welcome back to Real World Real Estate. I'm your host, Stephen Clyde with RE/MAX Preferred and RE/MAX at Cherry Hill. In this episode, we're going to be talking about mortgage programs, all the initials and acronyms you hear when you start your mortgage process, from VA to FHA, 203K, USDA, jumbo, conventional, non-conforming. We're going to discuss all of this with a real estate professional, mortgage professional I've known for over 11 years, unfortunately, or fortunately. Started with Commerce Bank in commercial lending and then title, and now owns his own mortgage company, We Lend. He's a South Jersey native, wrestled and went to Paulus 6. He's actually an Ironman also, a French Ironman for that matter. Competed the full Ironman in France, which is pretty cool. His name is Drew Whipple. And Drew, thanks for joining us today and taking some time out of your schedule to go over this with our clients and buyers and everyone that's listening to our podcast out there.
Thanks for having me, Stephen. I appreciate that.
So let's start in this a little bit. There's not one mortgage out there. If I'm a buyer coming in and I call you to get pre-qualified or pre-approved or discuss mortgages, when we say mortgage, that's one term that encompasses variations that are numerous, right? I mean, there's all kind of variations.
Yeah, I mean, so when a client calls me, I pretty much have a conversation with them first to kind of assess what their needs are, what they're looking to get out of the mortgage, if it's a short-term type mortgage, long-term type mortgage. So what we do is we run their credit, we run the application, we see what they're qualified for, and then kind of make a determination as to what the best program is. There's the FHA program, which is the government-backed program. It's a great program if you need it. Basically, when I say need, meaning that it allows for a higher debt-to-income ratio and also a lower credit score. So if typically my rule of thumb is anything below a credit score of around 700, I usually start to take them FHA for multiple reasons. One of the reasons is that the mortgage insurance is the same for everybody, FHA. So if you have a lower credit score, you're going to get the same mortgage insurance. And what that is when you put less than 20% down, you have to pay a monthly fee to be able to do so. And that monthly fee is the same for everybody with FHA. Now, as far as conventional is concerned, that's for folks that typically are above 700. They have an acceptable debt-to-income ratio. And what that means is you take your monthly debt divided by your monthly income, and there's a percentage. And if it's below 50%, we typically take them conventional. Okay. Now we also have the VA loan, which is for the veterans out there. We want to thank them for their service. It's an excellent program, 0% down. They have no mortgage insurance, again, which is, and on the other programs, if you put less than 20%, you have to pay a monthly fee, but VA, you do not have to. You got the USDA loan, which basically is in the rural areas. You could go basically no money down. There's a little bit more restrictions on that type of loan. So it's one of those, if it fits in the peg there, then it's a solid loan for putting no money down. There's also the non-conforming world. Basically, that world is kind of like, I like to say, the Wild Wild West, right? So it's all the loans that don't fit in the normal world, such as the self-employed borrowers. We know the self-employed borrowers are making money, but sometimes Uncle Sam doesn't see that. So with that, we have alternate programs where we actually pull their bank statements for the last 12 to 24 months. And basically what we do is we calculate what the monthly deposits are and determine what their actual income is that we can use. There's service industry loans for bartenders, waitresses, anybody in the service industry, hotel industry that they receive tips, but they're W-2 income, so they're not self-employed. So the W-2 folks, they can give me their W-2s. I can use that income plus I can use whatever they use, they deposit cash-wise. They might not report it, but I can still use that for income, for their monthly debt-to-income ratios.
All right. So let's stay with the what we're called the government-backed loans. So that's the FHA, the VA, and the USDA. And then FHA has two versions of it, right? 203K and 203B. 203B is just a straight purchase loan, and the K is if I'm doing rehab or the house needs work.
Right.
Now, a lot of times sellers or people that don't know any better will look at an FHA loan as a negative, right? It's a person with bad credit or no money or lower income. But that's not really the case, is it? I mean, it's a viable loan for anybody for different circumstances, but it shouldn't really have a negative connotation to doing FHA.
No, absolutely not. So the conventional world, there is a 3% down product for a first-time home buyer. However, if you're not a first-time home buyer, you might not be you might not be able to get the 3% down. So FHA with the 3.5% down might be the best option for you. So it's really, the FHA really allows a whole nother pool of clientele to be able to gain ownership of being able to buy a home. But again, it's what I do is I do a comparison, apples to apples comparison for the client, figure out what, how long they're going to be in the home, and then to kind of make the determination as to whether FHA is the best option for them.
Right. So so if I'm putting down the 3% conventional that you mentioned versus the 3.5% down FHA, my understanding the big difference there is going to be the mortgage insurance or the PMI, right? Because
that's correct. Yep.
We're permanent on the FHA, but it's not permanent on the conventional. Do I have my understanding there right? Or
yeah, that's correct. So to get a little technical, the FHA fee is 0.85% of the actual loan amount divided by 12. So, basically what that means is that everybody, whether you have an 800 credit score or a 580 credit score for that matter, that mortgage insurance is the same for everybody. Okay. So where the real benefit comes for the person that has something, say a credit score above a 700, that credit score, that percentage or the percentage of the mortgage insurance is fractionally less than it would be for FHA. So that's really where I make the determination. Then another factor is for FHA is there is an upfront fee. There's a 1.75% of the loan amount fee that gets rolled into the loan. Now, the customer doesn't have to come to the table with that money. It does get rolled into the loan. On the conventional side, there is no upfront fee. Okay. And another factor is mortgage insurance conventional drops off automatically at 78% loan to value. So basically what that means is once you have 22% equity into your property and you're paying mortgage insurance, that will automatically drop off. Now at 80%, you can actually call to have it removed by an appraisal with the mortgage company. Probably not the easiest process, so I typically tell my clients just to get it down to 78% to have it automatically removed. Now, FHA, if you put less than 10% down, that mortgage insurance is for the life of the loan, okay? Which, not a great thing. However, if the person needs to go FHA, meaning that that's the best option for them at the purchase, there is always an option down the line to refinance into a conventional to reduce or eliminate that mortgage insurance at some point.
Right. And another difference that, I can have, I think up to 10 conventional mortgages on properties, but I can only have one FHA at any given time.
So I believe there is the option if you have an FHA. So when you go with an FHA loan, it has to be your primary residence. Now, if that, for whatever reason, turns into an investment property down the line, and if you're outside a certain mile radius, I think it's 100 miles, you are able to use another FHA loan to buy a new primary residence.
Okay. All right. And then the 203K variance, that actually has two variations inside of it, right? Because we can't make things easy. So that goes streamline and just straight 203K at that point?
Right. Yeah. So there's really there's actually a couple different renovation type loans, and these types of loans are great because if you love the location of the property, but you don't necessarily like the style of the home, it could be like a Brady type style home back in the 70s. It's a great location, but you can do a 203K. The 203K streamline is if your renovation costs, I believe, is under 30,000 or so. Anything above the 30,000, there's a lot more restrictions. You have to have consultants, HUD consultants, be involved, and then there's also the conventional home renovation loan as well. So there's many different options. I basically just tell the clients, figure out what you want done to the home, and then we figure out what course of path or what product we would take to do the renovation.
All right. So just so I know you and I know what we're talking about so that everybody listening knows when we're talking about a renovation loan. So if I'm going into a house and we use that 70s Brady Bunch home or that 80s Miami Vice house where you think Crockett and Tubbs are going to come out from around the corner, and redoing the kitchens and updating the baths and painting and flooring and all that, these things can add up to money for somebody either on their credit card or out of their bank account. On these programs, you as the mortgage lender are lending them the money to redo the kitchen or the baths or the floors or the roof or whatever it may be, right? Up to that $30,000.
Yeah. So basically, the home, a lot of these homes that people buy are HUD type homes, or they're homes that were foreclosed upon in bad shape. You won't necessarily be able to get a loan with these in the actual how that home is actually positioned right now. There's a lot of walls falling down or whatever. It could be a magnitude of multiple things here, but so basically what we do is we come in, we take the purchase price, we figure out whatever the renovations are going to be. So you have your own people go in to figure out what needs to be completed. We roll that into the loan, and then at that point, we do an as-complete appraised value. So basically what that means is the appraiser will go out and appraise the property as if those renovations have been completed. Okay, and at that point, that's what we base our loan amount off of. And it's a great way to build some equity into the property right away as well. So.
Well, I think it's also a positive for people to understand that, especially in this market where we have narrow inventory and, every buyer wants a turnkey, walk-in, move-in ready home, and you're in heavy competition for those. But if you go into the one that is covered in wallpaper and mauve carpet and still has the old style 80s cabinets with lacquer finish and everything, you get an advantage now because you can step in and bypass that competition, I believe.
Right? Yeah, that's true. Yeah, a lot of people, a lot of folks will go into a home and say, we love the location. Yeah, this is not for us. The kitchen's too small or whatever. But it's like Stephen, like yourself, you go in and you educate the buyer to say, listen, you can get this all completed before you guys actually move in. You can purchase it, roll all of the closing costs in, roll the renovation costs in, and get the home of your dreams. And a lot of people, they're narrow-minded, and the agents are not really educating them to say, hey, there's programs out here that can do this for you.
So this is, essentially when everybody's watching HGTV and they pick up Property Brothers or one of those shows, this is essentially what they're doing is what we're talking about, right? They're saying you're approved for $900,000. It always seems they never do $200,000 homes on those shows, but you're
it's real. It's got to be real, right? All the time.
Right. Yeah. So let's assume it's a South Jersey property. You're approved for $350,000. We can buy this home in Sturbridge in Voorhees, which is a desirable location, for $275 because it's a foreclosure and it does need full updating. But you have the differential between that purchase price and your approval limit is your reno budget, basically, which is essentially what they're doing on Property Brothers all the time.
That's true. Let the money work for you, right? The money's cheap right now. The rates are low. As far as being able to get that dream home, a lot of these people can't buy the home and then do it with their own cash reserves. They depleted their cash reserves probably on the purchase. So this is the best option for these folks that really want to get that home up to snuff, up to their likings. So.
Yeah, I think it's a great program, we should definitely explore and market it a little bit more. It takes a little bit longer, obviously, to close. We're not closing in 30 days on that program, but I think it's a huge plus for buyers. And you're right, agents and clients need to be educated about it, including sellers for that matter. Since you just mentioned rolling in closing costs, this is one that usually catches sellers off guard. I don't think buyers fully understand it either. So when we're going to roll our closing costs in on a USDA, we can do it on any of the loan programs, right? It doesn't make a difference. Essentially, that buyer's just mortgaging their closing costs more so than the seller is paying their closing costs, right?
Right. Yeah. I mean, so what I do is for my folks that are a little light, they have the down payment, but they don't necessarily have the closing costs. I'll give you like an example. So if you're buying a home for say $100,000, the buyer wants to buy it for 100. The seller wants to sell it for 100. They want to walk with 100,000. So what we basically do is we come to the meeting of the minds. Okay, 100. We figure out what the closing costs are. Say 6,000, 7,000. What we do is we basically artificially inflate the sales price up to about 106, 107,000. Give the seller will actually give the buyer back the 7,000 in seller's concession, and then the only thing we have to worry about is that it appraises out for the 107. So that's the only downplay on this. Typically, when sellers are selling their primary homes, they're not really paying any additional taxes on that since it's their primary. If it's an investment, that could be a whole different animal for
right.
Tax gains and stuff. But it's the best thing, and because like I said, the money's cheap. Let the money work for you right now and roll in the closing costs.
Right, because I mean, I'm usually using the factor when I'm talking to a buyer about that, and let's make it easy math, right? $10,000 in closing costs. I said, this is only going to cost you $35 to $38 a month for that additional $10,000.
Exactly.
It's better to keep that $10,000 in the bank, and it doesn't cost the seller anything, really. We've agreed to a net sales price. We're all in agreement to it. Now, we just did one with one of our buyers where we had a under contract at $240,000. We told the seller, once we get the appraisal, we're going to roll closing costs in this, but we want to see what the appraisal is first. Appraisal came back at $246,000. We made an adjustment and an addendum, and we raised the price to $246,000. We took a $6,000 credit, so it's a zero sum to the seller, right? They're still at $240,000.
Exactly.
And in this market, we just wanted to stall a little bit on that appraisal, because you're right, the appraisals are the biggest issue on doing that. From a seller standpoint, I know sellers are used to old school FHA appraisals, which used to be notoriously tougher than conventional, but they're really not anymore. It's a non-issue right now unless it's a blatant health or safety issue, right? If the roof is falling off or there's peeling paint or exposed electrical wires, true safety concerns, then we could have an issue. But short of that, the FHA appraisal almost looks just like the conventional now, right?
Yeah. Back in the day, the FHA appraisals were super tough. Now I haven't really seen any issues. I haven't on the recent FHA deals done. I haven't had any repairs noted on the appraisal. So I guess they're loosening up a little bit, the appraisers. So that's a good thing.
So, and then that appraisal is attached to that property once it's done, right?
That's correct. Yeah. So if that transaction falls through, the seller, I hate to use the word stuck, but they're stuck with the appraised value for a period of 6 months on that property. So if another buyer comes in, they basically have, that mortgage company will have to send over the appraisal, assign that appraisal over to the new lender.
So that new buyer do they still have to pay for an appraisal, or do they get that free assignment, basically, a free card?
That's a good question. I don't think they do, actually. I have to find that out, to be honest with you. Yeah.
I've never come across that where I've been on the other side where the appraisal's already done. So it's that thought just popped in my head. I've never.
I don't think they have to pay for it. I don't. Yeah. It's a cost of doing business for the first time arounder.
Right.
But it's just I guess it's like a bonus. I guess maybe they have to pay an assignment fee. I don't know.
Could be. That's worth checking in. We'll check that, and we're added to the show afterwards for everybody. But from a seller standpoint, they shouldn't be afraid of an FHA borrower, an FHA offer, an FHA appraisal for the most part.
No. I mean, and that's been the thing in this industry where, yeah, especially in this time right now where there's 5 other offers coming in, and 3 or 4 of them are conventional, one's FHA. Unfortunately, the FHA sometimes that offer is not being accepted because the agents are telling them we don't want an FHA buyer right at this point because of the
right. Which is falsehood, and that's poor education on the agent's part for them. For most part.
Agreed.
And then when we talk about a VA, their appraisals are a little bit different because that appraiser actually doesn't even work for the buyer, right? My understanding is that appraiser works directly for VA then when they do their VA appraisal, right?
Yeah, well, they have to be VA trained and assigned. There's not as many appraisers out there that are VA approved. So yeah, it's definitely a specialty appraiser.
Okay, so when we talk about VA, and I do a fair amount of them, and I think it's the least we can do for anyone that's put their life on the line for our country, or even if they weren't in a danger zone, they volunteered to serve our country, and this is the least we can do for them.
Absolutely.
The only negative I've ever found with the VA is obviously they don't have to come out of pocket with any money, and they don't pay the mortgage insurance. But that funding fee can be rather steep at times, can it? Or is it?
Yeah, I mean, yeah, there is the funding fee, but basically to be able to put down 100% and not have mortgage insurance, it pays off pretty quick.
Okay.
If you were going with an FHA loan or conventional and you had mortgage insurance for 8 to 10 years, do the math, and that funding fee and the funding fee is not paid at the table; it's rolled into the loan. So
right.
For them, they're not even going to really feel it, to be honest. It's and there's with VA too. There's some folks that are partially disabled or fully disabled that they don't even have the funding fee. And I had one client, they bought a home, new construction down in Virginia, and they didn't have to pay taxes either. So, I mean, it's, they made the sacrifice for our country. So, and it's a great loan for them, and was super happy to make it happen for them.
I've only had one of those. It was here in Berlin, but he lost his leg in Afghanistan. So obviously he was 100% disabled from combat. So he had no funding fee. And then the state of New Jersey waived 100% of his property taxes at the same time, which again, I think is the absolute least we could do.
Absolutely.
For someone who made that sacrifice for us.
Exactly.
Is there, if someone is served and, they're honorably discharged, is there anything special they need to get directly from the VA, or can they just talk to their lender about a VA loan? Is there an extra step involved for them? Or is it just
they have they'll have their DD 214, which is basically just breaks out their branch, the years of service. There's the veterans are told never to lose the DD 214 because it's super important. The certificate of eligibility, my company, we basically will order that for them, do the steps for them. Some folks will actually have the certificate of eligibility, and basically what that tells is if they would be eligible to purchase a home. Now you can buy a home VA, and then if you're selling it and buying again, you can use the eligibility again as well. So meaning that you can use the VA benefits on a home purchase multiple times.
Right. It's not a one and done deal, right? You keep that benefit for the rest of your life, basically, to use your VA.
Right. Exactly. So, but the way it works is basically they'll sell their existing home and then buying the new home right after, and then they'll be able to use the eligibility again.
I think I've had 1 or 2 occasions where we've had active duty and they're deployed, mm-hmm. and their spouse is purchasing the new home using the VA, and I think they got compensating factors because they were deployed that they could carry 2 at once while they were selling the primary in their move, because their base of operation was being moved from, let's say, Lakehurst to Norfolk.
Right.
So they weren't stuck with that 1 at a time. They were allowed to carry 2, I guess, because of the deployment, or was that incorrect on our end or my mistake?
That's something that I don't know the exact answer for that. I would have to find that out.
Okay. And it's just the veteran This benefit doesn't pass on to anyone else, does it?
Right. It's the veteran has to be on the loan, and they're also the.
Does a surviving spouse get any VA benefits for a mortgage at all, or it's just the spouse that served?
Good question.
All right, we'll check on that. All right.
I'll have to find that out. Usually when I'm doing the VA loans, I have the veteran. So.
We get a fair amount of them here, but not as much as we used to.
Yeah, I deal with it sporadically. Just, I'm like, obviously, we're in the South Jersey area. I mean, more in like the boarding town area. That's where you're going to see more, because of the base up there. So.
Right. The closer we are to the bases, the more we see it. Now, let's talk about benefits we give to people that serve. I know this next one is basically, as far as I know, just the Jersey benefit for New Jersey responders. But if you are a professional fireman, not a volunteer, or you're in law enforcement and you pay into the police and fire pension system, they have their own special benefit for those people, correct?
Right. So state in New Jersey, if they pay into the PFRS pension, so they have to pay into that pension. So it's the local police officers, full-time firefighters. There's the court, not the court, the
Sheriffs,
the sheriffs, the folks that work at the jails,
state troopers.
Yeah, there's a couple other outliers as well. But if basically in a nutshell, if they pay into the pension, then they qualify. And what they do is they qualify for this program, and basically they use the pension money to lend out to their members. And right now the rate, I believe, is at 1.51%, which is significantly lower than where we are right now. We're in the twos on a conventional FHA, but imagine being able to get a rate around the 1.5% range. It's insane on a 30-year fixed loan.
That's amazing. That's for primary residence purchase, or can they use it for anything else? Or?
No, it's primary use only. They can have a police and fire loan as long as they pay that off prior to. They can buy again. I got a flood of calls in from police officers across the state when we were posting the advertisement about it. It's not for refis, it's only for purchase. So they used to be for refis, and that was absolutely insane when I worked for a bank at the time, and they had the program, and the refis were still open. It was just, thank goodness they put a stop to that. So it was insane.
So does this look like an FHA loan, or does it look like a conventional loan?
Yeah, so it follows the Fannie Freddie guidelines. So you could do as little as 3%. The majority of them either put 5 to 10, 20% or more down. It basically just follows the same exact conventional guidelines. It's a pretty straightforward loan. There's a couple different caveats to the program. There's a monthly fee that you pay to the pension. It's like $37 a month, and then after month 31 or 37, I think it drops down to like $18 a month. So there's a little bit of extra you got to pay, but with an interest rate of 1.5% range, who cares?
Pretty much, yeah. And again, that's the least we can do for our first responders. I think that allows them to live and afford to live in the communities and neighborhoods that they serve. And I think it's great that the pension's reinvesting back into their own members instead of Amazon or Google or some other crazy investment, right? I mean,
right.
Basically, they're providing the return and the security of their own pension fund by their pension investing in them.
Yeah, absolutely. Yeah, it's like I said, it's you have to have 1 year of service to be able to purchase the home with this program, and then you have to be active. You can't be retired. So I've gotten a lot of calls from retired police officers, but unfortunately they don't qualify. You need an active participating member.
All right. So as long as you're paying into police and fire pension in the state of New Jersey, it's the program. And for anybody listening that meets that criteria, Drew's contact information and WeLend's contact information will be in the show notes. So you'll be able to reach out directly to him, and he'll be able to walk you through the process and what you need to do there. And that applies to all the mortgage programs we talk to, not just this one specific one. But I do know on this program, there's a very, very small number of lenders that actually manage and offer this program out, right? I mean,
That's correct. Yeah, there's lenders that have it, but the problem is there's a lot of restrictions on it. There's just not a lot of profitability on the loan. So there's certain designated companies that will do it, and they do it well. So you want to make sure that you're working with somebody that understands the program, knows the ins and outs, because you got to be able to coordinate with the state, because there's a program through it's through them. So
is this something where if I'm working with a buyer that qualifies for this program, is this something where I want to give them a little bit more lead time on settlement because we're going to go through Trenton also? Or
yeah, I mean, I would say 45 days, 45-day close. If you're working with somebody that knows what they're doing, you might be able to do 30. I mean, with the volume right now, with the low interest rates, and a lot of companies are at capacity right now.
Right.
You want to at least give 45 days for a police and fire loan purchase.
All right. So, and then there's USDA, which I grew up knowing as Farmers Home Administration, right? So that's another HUD program that coincides with FHA.
Yep. Yeah. It's 0% down, which is awesome. There is a funding fee, just like the VA gets rolled into the loan. Same thing with FHA, gets rolled into the loan. There is mortgage insurance component to it as well. Like I said, previously I talked about there's certain restrictions, and the restrictions really are the debt to income ratio. So you really have to be able to afford it within a reasonable level. And also there's income restrictions too. Okay. So if you make too much, then you don't qualify for USDA, and it's household income too. So you have to figure out whomever is over the age of 18, you figure out all their income for the family, for the household, and then you determine whether they would qualify for the income restriction.
And then we have to do the MAP qualification too, because the house has to be.
Right. Yeah. Obviously, it has to be in a rural area. So a lot of times what I'll have is my agents will reach out and say, hey, here's the property. Does it qualify? And there's actually right online, there's the eligibility property. So you just type in the address and it'll show if it's in the grid, if it's in a rural area. And you'd be surprised sometimes areas you don't think were actually in the rural area, they are, and the home actually qualifies for USDA. So always check for that. And we do that for our clients.
Well, I remember up until a couple of years ago, sections of Mount Laurel that used to be farms when they originally drew the map will still qualify, but it was a densely populated condo area like Larchmont and everything. And
right.
But I think they redrew the maps 5-6 years ago, or
I believe so, yeah.
But up until then, those condominiums fell into the rural program. So the government decides to update their maps, because you're right, there are certain areas that if I tell you it's rural, you'd look at me like I was crazy.
Exactly. I was surprised a couple times on some of them.
All right, so that's a wonderful program. And then we get into traditional, what everybody shoots for. They want to be 20% down, conventional buyers, right? There's lots of variations inside the conventional programs too, right? We don't have to be at 20%.
No, nope. Yeah, you could do, with conventional, like I said before, you can do the 3% down product for the first time home buyers. Traditionally, if you did the 5% down, you'll make out a lot better in terms of the mortgage insurance payment, which is that monthly fee payment. The difference between the 3 to 5% is a big difference. So I always try to tell my clients, try to at least get 5% down. You don't need the 20%. There's so many folks out there that still believe to this day that they need 20%, which is shocking. But you can buy the home, and mortgage insurance, you got good credit, it's very reasonable. So it's one of those programs that, like I said, if you qualify, you have good credit, you have the money. And again, you can always use the seller's concession too to gobble up the seller's concessions. And also you can always get a gift too. You can get a gift from family for the full down payment and closing costs. So you don't really have to have a dime into the game.
Yeah, I wasn't raised with a family with that kind of means, so.
Nor was I.
That's why my first one was a minimum down seller's concession FHA loan. Yeah, I wasn't that lucky birth, right? I didn't win the birth lottery and be able to set up with that. But we can all, I think a lot of people are afraid, or they think they have to avoid the mortgage insurance when they're going to program, and that's why they're shooting for the 20% down. I've consulted some clients along the way saying it's a better deal if you put down your 10% and just prepay the mortgage insurance and take it off the table than putting down the other 10% and use a lot, use as much of the bank's money as you can.
Yeah, I mean, here's the thing. What I do is I tell clients will come in and say, I don't want to pay mortgage insurance. I'm like, all right, well, let's see what the mortgage insurance will actually be per month. And then when I tell them they're buying, a $300,000 home and it's, putting 10% down and it's $90 a month. Oh, it's only not, it's only $90 or $100. That
Right.
makes sense because, if you're buying, if another 10%, that's another $30,000 on a $300,000 deal. It's a lot of money, right? So, and if you have to pay, say, $100 per month, I think it's worth keeping that $30,000 in the bank or let it work for you in the market. I mean, there's a lot of opportunity right there in the marketplace too. So,
well, I agree with that, and that's how I counsel clients all the time. That we're looking for a balance point, the down payment and the payment on the first of every month, right? We're trying to find that happy medium without going overkill on the down payment, because as you've mentioned several times, interest rates are extremely low right now. So you're better off borrowing the money than using your own. And the only way to get your own money back out of your house again is to go back to a bank and re-borrow your money in an equity line. So you're better off keeping that extra 30 grand in your bank, even if it's in a money market, so you have it for reserves or emergencies instead of having to go borrow it.
Yeah, and another little thing too. Now it really depends on how the market's going. I'll give you an example. Like for instance, any purchase that we put on the books about a year and a half ago, the rates were obviously in the fours, right? So right. Now what we're doing is we're taking them, we're refining them, and what we're doing is the Fannie and Freddie allows us to do the refis with no appraisals. So I can get a value where now they have the 20% equity in the property, and I can drop off mortgage insurance. So I've had probably 30 people already this year where they bought about a year and a half ago with mortgage insurance. I was able to, one, not have to do an appraisal, and number two, I got their mortgage insurance removed, and I got their interest rate dropped in the twos. So it was a perfect storm for that. So
I would think somebody that's in the fours from a year, 18 months ago or so, and now can come in and where were we at, 2.7, 2.8, or have we dropped again?
Yeah, right in that ballpark.
So if you're saving over 1.25 or 1.25 percentage points in interest, because I want to use the basis points analogy, you might even be able to shorten your term to a 15-year and not really change your payment at all, right?
Yeah, so some folks went with the 15, but here's the crazy thing is, so the 30, the 25, and the 20 year, at least with our investors, the interest rate is pretty much the same, right? So I tell folks that if you're going to go with the 20, why don't you just do the 30, get the same interest rate, make extra principal payments, and then you have the option of being able to pull that plug out if something changes, you lose your job or whatever. You don't have that make that aggressive payment anymore. So they just remove the extra principal reduction on their loan. So that was another feature. But yeah, I mean, folks definitely did. They went with the 15-year to basically speed up the payments, and they're actually some of them are paying less on a 15 than they were on the 30 with their interest rate on the high fours.
I mean, I bought my house 4 years ago. I thought I hit a home run getting a 15-year rate. I was at 2.875% on a 15-year, which is phenomenal. Now my buyers are getting better than that rate on a 30-year fixed. So it's
yeah. I mean, the FHA rates right now are just they're in the low twos right now, and it's just insane to be able to even imagine. I wouldn't even imagine that the rates would be in the twos, let alone now in the low twos.
All right. So in FHA low twos, are we talking 2.4, 2.5, or?
So I just put somebody at like 2.375. It was like a $300,000 purchase, 3.5% down. So
on a 30-year?
On a 30-year, yes.
Wow.
Yep.
So the conventional's about a half a point higher than, give or take.
Yeah, I would say a little less than a half a point. Because I mean, a couple of the conventional deals I put in at like 2.75, somewhere in that ballpark. It really depends on the situation, the timing, the day, the investors. It's all about hitting that at the absolute right time. So I'm constantly tracking the market, where the rates are, and my clients that are floating. I tell you, I said, if you see my call coming in, you better pick it up. If you want me to lock that rate for you.
And essentially, if they're in that float mode, and floating means you haven't locked your interest rate in for everybody that's looking, you haven't locked it down yet.
Yep.
They should be paying attention to CNBC or Fox Business or whatever business news they follow, and they should be tracking the 10-year Treasury, right?
Yeah, I mean that's one of the rates to watch. Typically, when the stock market gets pummeled, you want to look and see where the rates are right away, because now they're pulling their money out of the stock market and putting it in the bond market, which then drops their interest rates for us.
So if I'm buying a home, as long as I don't need my 401k for my down payment, I'm going to root against my retirement plan to get a win on my mortgage rate.
Right. You just want that temporary relief. Get the lock in and want your stock market to boom.
And just so everybody knows, when we're talking conventional, these are essentially quasi-government-backed loans because they're purchased or they're underwritten by guidelines set by Fannie Mae and Freddie Mac, which are quasi-government agencies, companies, however you want to describe them today after 2008. I don't know their permanent structure, but they're set guidelines. So it doesn't matter if someone calls We Lend or Bank of America or Wells or anybody else. Everybody is following the exact same guidelines, right?
So with us at We Lending, we basically we deal exactly, like, our restrictions are what Fannie and Freddie say. Now, if you go to the big banks, they have overlays. Okay, so they have additional conditions that they put on top of Fannie and Freddie guidelines, and as well as FHA guidelines. So I'll give you an example. So I won't mention any of the bank's names, but I had a client. I was talking to them briefly. They wanted to use their bank. I said, that's fine. Just let me know how it goes. So they go with the bank, and about a week before settlement, I get a call, and I'm like shocked. I'm like, why are you guys calling me? I thought you wanted to go with the bank. Well, Drew, you were right, and they declined us. We're a week out of settlement. So I said, okay, I already have your file. I kept it because I knew probably this was going to happen. And we ended up closing it in 10 days, which I like to do 10-day closings, but we can make it happen. But basically the moral of the story is they had an additional overlays, more rules on top of what Fannie and Freddie say. So when we got the deal, it was a no-brainer because I didn't have those additional restrictions. So, and we were able to make the deal happen, and that's just one story of many.
Right.
Of the big banks with their overlays.
But the baseline requirement should be the same, and then each individual, and it's usually the major banks and the Wells and the Chases and the Bank of Americas and all, that add to it on top of it to reduce their additional risk.
Exactly. Yep. Yeah, because and I forgot to even tell you this point. The greatest part of that whole story is we sold that loan right back to the same bank that declined it.
Well, that's where I was just going to go. They're especially Wells, because they're one of the biggest, or Penny Mac or whatever. They're on their retail side, when the client's talking to them directly, they're putting these additional rules in.
Yep.
But if they go to a WeLend or someone similar to you, Wells Fargo is still going to buy that loan from you anyway without those additional restrictions, right?
Yeah. And the thing is they're buying that loan, they're servicing it. So they're basically collecting the payments. So their risk factor is out of the equation. So now they're just servicing it. So what we're doing is we're writing the loan. We know what Fannie, Freddie, FHA guidelines are. We meet those guidelines, and then we basically sell it right back over to Wells. So now Wells will be basically just collecting the payments.
So in theory, as a buyer, I could go into Wells Fargo. They could decline me for my mortgage. I could go to WeLend. You approve me. I go to closing on my house. And 60 days later, Wells Fargo is still my mortgage company, even though they declined me.
That's correct.
Crazy. Interesting world we live in.
Yep.
So the conventional loans have a purchase limit on it, and they're regionalized, right? And they're actually beyond regional. They're almost localized. So down here, we're at what, 525, 100 is our cap?
Yeah, it's 510, 400 right now.
How did they come up with 400?
I have no idea. It's percentage of the median home price. I don't know who makes it up, but I heard that that limit is actually going up, which is awesome for us.
Well, yeah, because we used to be in the low fours like 10 years ago.
Yeah, we were like 417 for not that long ago. So
yeah, but now that'll change even inside the state of New Jersey we're at, because I know up north where my daughter and son-in-law live, that number is like 725.
Right. Yeah. There's like pockets all over the place. So in the North Jersey zip codes, they can actually still buy in the conventional world. It's called a high balance loan before it goes into what we call the jumbo world, the non-conforming world. So anything above the 510 down here in South Jersey would be considered a jumbo loan. And there's different restrictions. A lot of the jumbo loans are portfolioed, so which means that the bank holds that paper. So they have many restrictions on those loans. So some folks will have to, if they don't meet those guidelines for jumbo, then they have to use additional monies to basically buy down that loan down below the 510, 400 limit.
So I remember, now it's just changed recently, but traditionally the whole time I was in real estate, there was an interest rate penalty for slipping out of conventional and into jumbo world, right? Exceeding that limit, the banks charge you a much higher interest rate than they did the others. Then we slipped down where the jumbos were less expensive on their interest rate for a while, because I know back in December when my daughter went to settlement, she was about a quarter point below conventional as a jumbo, as a 10% down jumbo. But now it's gone back the other way again, right? The conventionals and the government loans are less than the jumbo.
Yeah, right. So I would say that jumbo had the advantage, I'm going to say at least 8 to 10 years, at least. But yeah, obviously when COVID hit, we all kind of benefited from with the lower conventional rates dropping, FHA rates across the board. So right now, you actually would benefit better by going with a conventional product than would be the jumbo product. But don't get me wrong, the jumbo rates are still phenomenal as well. It's just that we have a slight advantage in the conventional world right now over jumbo.
And I'm working on one now for a client, and they're buying a second home, a sure home.
Yep.
And now I'm realizing that some of the banks have changed the down payment requirement. So now they're looking at 25% down instead of just 20. Is that something you're seeing across the board, or is it just one in particular lender? Or
yeah, I mean, I haven't seen that. Our company does jumbos. Our jumbo refis are pretty insane right now. We're actually beating the bigger banks on the refis section of it. But on a purchase, the banks they're predominantly the big dogs in that market. I mean, that's their focus point. It's their loss leader. They bring in the jumbo product and they sell all the 50 million other products they have at the bank. But as far as a down payment is concerned, as far as I know, it's still 20% is usually the norm. But there is, on a primary, you could put less than than 20% down, but there's a lot more restrictions on that. So I don't know about the 25%. I haven't heard that yet.
And again, that was just something I heard not directly from the lender, but so I do want to do a little research on that. No, but my daughter took out the 10% jumbo and closed in, actually you worked on the deal,
Yep.
And closed in December. But yeah, there were other restrictions where they needed to prove and show their reserve amounts and,
It was the reserves, and it's also the debt to income ratio. The debt to income has to be below like 35%, which basically means that 35% of your income is going toward debt, no more than that. So that's a big restriction. So I mean, it's a lot of folks are usually over that 35% mark for the debt to income.
So it's not, and just so everybody's clear, when we're talking about this limit, we're not talking about a purchase price. Buying a $525,000 home doesn't convert you into jumbo. It's how much I'm actually borrowing on the mortgage, right? So a 525 more likely on a purchase isn't going to create a jumbo. You're still conforming for the most part. But when I start getting into the $700,000 price point and even putting down 20% in our market here would still trigger me in the jumbo mode.
Exactly. Yep.
All right. And then we have some of the, I used to call them the liar loans, but you call them non-conforming loans now. So we brought those back since the crash, and they're relatively new back on the market again, right? In the last few years, or?
Yeah, they came back. I was doing a good amount of them, and then March hit. And I called my investors, and there was just no call. Nobody was calling back, and obviously they all, a lot of them got laid off, and companies shut down, and it was a complete mess, and it's just that market is they get hit the hardest when there's a downturn. So, but they are coming back. I am getting their emails again, which is good. They are picking up their phones, which is good. So the bank statement programs are definitely out there right now. There's a couple investors of ours that are definitely doing them. We're brokering them now. So before we were correspondent, we were basically writing it on our own paper and then selling it. But we're directly brokering those deals now, just because of the risk factor.
And that's really for someone such as myself that's self-employed and a 1099 income. So you're going off my commission deposits, not necessarily what I'm right, and you're not looking at what I'm writing off on my Schedule C and my net income to the IRS.
No, yeah. So I don't want to see your tax returns. I don't ask for them. Don't give them to me. What I do ask for on these types of loans is either 12 to 24 months of bank statements. Basically, take those bank statements and see what your deposits are. Figure out what deposits are good. If there's money going back and forth into one account to another account, obviously it doesn't qualify for income. But you'd be surprised. I mean, a lot of the folks that I've done, it was a great program for them. They would have never been able to buy, which is unfortunate. But now we're able to do it. So they were super pumped to be able to buy a house and maybe not necessarily report all their income for tax.
Well, I mean, it's not about reporting income, and I don't hide any of it, but I always found that as a self-employed individual in 1099, I was treated at a different standard than a W-2 employee when it came to mortgage lenders, right? Because if you looked at buyer A that was a W-2, grossing the exact same dollar amount as me, you based this qualification off as gross. But then you looked at me as a 1099 and you based my qualification off my net. So now it looks like these programs are giving me the same benefit that the W-2 employee. You're looking at my gross income, not my net. And we're playing on the same playing field now.
For the bank statement programs, absolutely. Absolutely.
Which evens it out and makes it more fair, right? Because if you looked at every other borrower's net income after taxes and their health insurance deductions and their 401k deductions and everything, just like you do to a self-employed individual, they would never qualify for what they qualify for now either.
Right. No, you're right. Absolutely. Yeah, I mean, it's like I said, it's the, even with the self-employed borrowers too, some of them don't even have to do the bank statement programs. They write off certain factors, non-cash, such as depreciation on their assets, amortization off their intangibles. They might own a property. The corporate returns, I can understand, the Schedule C income. So it's a pretty it's very easy for me to figure it out. But a lot of folks, a lot of lenders don't understand it, and they decline their borrowers when they really shouldn't have.
All right, cool. And all these programs costs are pretty close, right? The appraisal is going to cost about the same. Origination fees, all the closing costs, all that's all going to be about the same. So it's really what meets the borrower's needs and financial situation best. Not that one program's better than the other, but what fits best for the borrower at that time in their lives, right?
Absolutely. Yeah. As far as the non-qualified mortgages, the bank statement programs, there's additional fees there because we're dealing with, an outside investor on those deals. But your internal deals, your conventional, your FHA, your VA, USDA, our fees are the same. For VA, we don't charge any bank fees at all, or like any mortgage company fees. We waive them for our veterans. So that's another nice little feature that we have here. But our fees are the lowest of the industry, and so it's pretty basic.
So it's truly what meets my needs, not what's best. And one's not better than the other. It's what meets my needs and requirements at that time, right?
Yeah, exactly. Yeah, and that's why, like, if somebody's borderline, whether they should go FHA or conventional, I give them a side-by-side comparison. I tell them my opinion on what I think. Obviously, being in the industry long enough, most people value that. So, but at the end of the day, they make the decision as to what they want to do.
All right, perfect. Well, I don't want to hold you up anymore. I know you got a lot of pre-quals to get done, and I'm sure your phone's been blowing up while you have it on silent.
Yeah, it's been lighting up over here.
I'm not even looking at mine because mine will be doing the same exact thing. So I want to thank you for giving us the time today. I think it's a lot of great information for all of our listeners. And WeLend is licensed throughout the country for the most part, right?
Yeah, we're licensed in about 20 different states right now. So it's you give me a call and we'll figure out what states we are in, and obviously everything right around the South Jersey, Pennsylvania, Delaware, all these states around the area we're licensed in. So we'll be happy to help you guys out.
And then any of our listeners, Florida, California, out west.
Yeah, we have. We're actually, the company's based out of California, so we have a huge hold on the California area, right near LA County.
Okay.
So we're all over. We're in Vegas. It's just all over Mississippi, Michigan. So you name it, we're probably in that state. Tennessee. So just give us a call. You might have family out in those parts that are looking to refinance or purchase right now, and love to help them out.
All right, cool. So I appreciate it again. Have a great day. Let's have a great month, and hope this market continues for us, because back in March I was scared to death. I'm sure you were as well.
Oh my gosh. I was going on food stamps then, but it all turned around for us. So
I was making calls to my attorney, like, am I going to have to file for bankruptcy? Like, what's going to happen here?
Yeah, it was scary. And we're very fortunate. And, I do feel really bad for the folks that are in different positions than we are. But we're here to help them out, give them low interest rates that they help them with their loosening their mortgage payments.
All right, great. You have a great day. Thanks again. And it was a pleasure. I had a blast. Take care of yourself.
Absolutely.
All right. See you.
See ya.